All right, well, if we were hoping for a buy the dip to occur today, we didn't quite get it. And now the question is, is that a sign of weakness? Are we going to get it tomorrow? Can we get some strength in the overnight? As we did last night, as we're kind of getting right now tonight, is that going to follow through? Is it better not to get the strength? So we're going to break down what the technical indicators are telling us. Is this like, have we actually had the end of the intermediate run? Like, a lot of people thought that was the case last Monday, and then we kind of said, hey, if we're actually going to be in an intermediate decline, we need people to think it's already over. And that seemed to be the case by the end of last week. A lot of people were talking about it's already over, and then Tuesday happened. So now, like, what are all the other are all the other indicators showing us that this is like, man, we've really had a pullback here, and we're probably closer to being done than we are to the beginning? Or is it the other way around? So that's what we're going to talk about in today's video. And we're going to talk about one area of the market that's really leading to the downside, and talk about how to trade it with today's trade ideas. So let's go ahead and get started. Today is Wednesday, September the 29th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 with the Market Forecast Indicator. As you can see, we finished near the lows of the day today. We are up a little bit in the after hours, but we do have the dark pink shading in the red line still. That's going to stay, barring a tremendous run to the upside here in the next day or two. That's going to stay dark pink shading and red line for a little bit of time. The intermediate line has rolled over. Is not in bearish territory yet. Was briefly there. Came back out into neutral territory, though, still in the lower half of the neutral territory, and now has rolled back over. Short-term sentiment has really dropped. You can see the near-term line. Momentum line still oversold. It has been in the bearish territory for much of this period. Still oversold now, and the near-term line getting again down below. Like, this is the second time it's been below the 10th percentile. It never did get below the 10th percentile all of this period of time. So very unique, and coming off a period where it was unable to get above the 90th percentile during that bullish run. Kind of showed how weak that bullish run was, especially when we started to really taper off with low ranges and volumes before getting above the moving average, just like we talked about previously. So we're still bearish. We're still bearish on the S&P. You can see the Dow looks almost exactly the same, though its intermediate line hasn't rolled over yet. So that's why you have the dark green shading there, because it is rising above 50, though barely above 50, still neutral zone, and obviously a pretty bearish short-term sentiment there as well for the Dow. The Nasdaq looks a little bit more bearish. Its near-term line dropped down to extreme lows, right down to the 5th percentile, below the 5th, which it hasn't done that. It didn't do that during that pullback. It started with down below 10 there, but it didn't get below 5. And then over here on the cluster at the end, it got below 10. At the end of that near-term run, though you did test the low a couple days later, but that was it too. Like, it didn't get below the 5th percentile, and you can see if I were to go back a couple of years here to the September-October drop, you can see again it dipped below, or got to 11 there, and dipped below 10 over here, got down to 8, but never did drop below 5, and of course, during the COVID low point, it never did drop below 5. And that was a really deep run, but you can see the lowest we got was 5.5. And remember, we're below 3.5. Come back to some of these other levels. And again, you can just see how rare it is. Over here in June of 2019, when we had that May decline there, the near-term line got to 7. Didn't quite get, it got below 10, but didn't get below 5. Here in Christmas, it finally did get below the 5th percentile, about as low. Had a cluster there, but that was really, really bearish. And again, it kind of shows just how bearish it is now. Like, that's pretty significant considering that the previously you would get down into those levels when the intermediate line was already below 20 itself. It's in bearish territory finally, so it's getting its third intermediate pullback in the same time frame that the S&P is just barely starting its first, but it's not as extremely low as we saw in other periods. Finally, the Russell 2000, which again was so looked like it was so bullish here on that near-term run, and a lot of people talked about how it was breaking out, and you can see not only did we reverse that move with today's, in fact, reverse 2 days of moves with that move there, closing below those lows. Well, today we actually closed below yesterday's low. So pretty significant from that standpoint in terms of continuing the trend. I'll come back to this chart here in a minute, but you can see how we, it was a lower high and a lower low, and we weren't very much below the low point, but we were just like right there. So pretty bearish all around the board for all the major indexes, and we've kind of talked about this before, and you can see we're still in bullish territory, so we're not really bearish yet, but extreme lows on that short-term sentiment too, down to below the 5th percentile. So it kind of just goes to show that we are, this is a pretty significant short-term sentiment that can lead to more selling, that the Russell's still in bullish territory, the Nasdaq's just barely getting into bearish territory. The Dow is and S&P are in neutral territory for both of them, with the Dow pointed upwards and the S&P barely turned down. So we are hardly, like, from an intermediate standpoint, like strongly bearish, but from a short-term standpoint, it seems like that's enough of an indication that we'll get more bearish on the intermediate. Again, I know when I say that, it might imply, because it's, when you watch TV or you talk to people on Twitter or whatever, that you're either all aboard this bullish train, or you're expecting the markets to fall off a cliff. And the reality is, I know that those two voices are the loudest voices out there, but the reality is, like, we'll get a little bit of a drop, as we've seen in the past. Whoops, not this one. As we've seen in the past here, right? We're still not even the 5% yet. But as you can see, we'll get a little bit of a drop, and every time you get a little bit of a drop, 5 to 10%, you can see the green tags that come afterwards. So it's hardly the end of the world. It's not going to be the end of the world. There'll be a lot of loud voices that will suggest, and even when you got the COVID drop, which we're not going to get another one of these, but even when you got the COVID drop, you can see we had a 12% drop. We still had 5% rallies or more rallies off of those lows before we finally came over here and had a 17% move followed by a 5%, and a 30% move followed by a 7%, and then 20% move followed. So it's hardly going to be a horrific incident that we drop 5%, or for that matter, if we might even come down to like 10%, down to this 38.23, which is kind of about where I'm expecting. Worst case scenario is what I'm expecting that will come down to. Well, most likely, otherwise we'll probably just come down here to this 23% level, 42.20 in this area, and just on an intermediate basis. So when I say intermediate versus market sentiment pullback, I mean the intermediate line gets below 40 and turns up. That's an intermediate pullback. A market sentiment pullback would be this dotted orange line getting below 40. An intermediate decline flirts with the 50-day moving average. Flirts with the 50-day moving average here. Typically, an intermediate decline flirts with the 50-day moving average. A market sentiment decline flirts with the 200-day moving average. And of course, getting below the 200-day moving average now starts flirting with a death cross environment, which is a little bit more of an extended, a deeper market sentiment decline. Again, from a COVID standpoint, which is our last death cross environment that we had, you can see how when we got below the 200-day moving average, then we were now in death cross environment. Getting to it is one thing, and that's, if you go back even further to 2018 was our last. This was a market sentiment pullback. It got to the 200-day moving average, held it. This was a death cross environment. We got below the 200-day moving average, right? And so intermediate pullbacks like this one gets to the 50-day moving average and then rallies. And even here we had an intermediate pullback that actually did get to the 200 and probably could have been more of a market sentiment. But here's others where you flirted with below the 50, but not quite really flirting with the 200 very much. That's more of your typical intermediate declines there. So we've been so bullish for so long, it just, when you've been so bullish for such a long period of time, you bring up that 50-day moving average close to where you're at, then again it gets really easy to break it and test the 200-day, as you can see when we hit these levels. Here's some levels over here. These are other intermediate pullbacks in 2017 where you can see we only hit the 50-day because we had such a wide gap there. So that's kind of what I'm talking about, and that's what we're seeing right now. If you look at the three green arrow charts, you can see we're back to light pink shading here, or back to pink shading on the S&P, on the Qs, not quite on the diamonds yet because we don't have the red arrow on the MACD, and then not quite here on IWM because the stochastics and the MACD don't have it. I guess the stochastics isn't there yet on the diamonds either. But you can see the others are light pink shading again, so you expect that we'll probably get pink shading on these two. You can go pink to clear, but we typically don't get to green. Like again, you know, if you only get the pink for one day and turn back up, that's typically how the bullish bounces work. Three red arrows are really good bullish buying signals. You can see here, one day of light pink, one day of pink, and that can be a good buying signal there. Right over here too, another 1 day of pink, and then you're back up again. But when you don't bounce back up after 1, maybe 2 days of pink, here's 2 days of pink, and you bounce up, then that's when you're now in, on this chart, intermediate pullback mode. We did get a smaller range today below the average, so a little bit of a pause. The volume tapered off, but still above the average at 82 million shares trading hands. If you take a look at the two-line versions of SPY, the 8 and the 17 day now both crossed below the 50. The 30-day hasn't yet, but these two have, and so that's a consideration when they first of all, you got to get the price below the 8 and the 17. Then the 8 and 17 have to get below the 30. Then they have to get below the 50. So I mean, we are in intermediate pullback mode according to this chart. Right? Every chart's kind of got its signals for that. When you look at the RSI, we are still kind of flirting with 40 and negative 100 there. We're not quite like breaking down hard. The NASDAQ is more. I mean, that's well below 40. Though you see we're setting up a bullish divergence on the CCI with a much higher low point than what we had over here on that long lower shadow. Interesting that on SPX, we have not closed below that long lower shadow. Long lower shadows during bearish runs can be support levels at the bottom of those shadows. So SPX has not broken below that shadow, but the NASDAQ has, right? So that's a really important consideration in terms of, you know, how much longer we'll be in this intermediate decline. If you look at the DMI, you can see we are well above 30. We're back to being well above 30 on SPY. We're back to being well below 20. So, you know, we are in a bearish mode. We are just rising above 20. We haven't gotten above 25 yet, much less getting that ADX up to higher levels. So we're, you know, this chart suggests you're just barely getting started. This chart says we haven't even started yet. Both lines are in between 20 and 25, not showing much of anything. The Qs, on the other hand, we are well above 30, well below 20, and rising ADX. It's moving up towards high levels. So we are in pullback mode there again. Let's take a look at the Ichimoku trend cloud. So SPY got back to 2. In fact, it got below 2, minus 2.13, and got above 65. So again, 1 day and just barely. So I wouldn't say that's a breakdown, especially since we're still above the cloud. But 2 and 65 are the important levels. If we follow through here and break below the cloud tomorrow, and especially if we follow the NASDAQ suit and close below that low point, then that's bearish, right? And again, QQQ is not quite. We were so bullish, and we're still in the cloud there too, and it's more bearish than the S&P now. But you can see it's still only at minus 0.5 and 35. So it still doesn't even have a weak bearish trend yet. Weak bearish trend would be below -1 and above 50, and we're not there. IWM, of course, very noisy, right? It's closer to 0. In fact, it hit 0 on both of these again today. So not very much of a move going on at all. SPY, you can see we are in the lower quartile. We're still in the lower quartile, so that's still bearish there. IWM is still in the middle of its bandwidth, so that's why it's not as bearish. QQQ had broken below its band, is pushing down lower. The Qs, the bands have closed outside. They moved outside of the bandwidth is rising. They've crossed outside of the Keltner channels, and you notice we are trading now below the lower Keltner channel. So right in that gap, this is where trends exist, between the gap between the Keltners and the bands, with that bandwidth expanding, with the momentum getting stronger, with green dots. So bandwidth rising too. You can see it's not as high as it's been. Like that bandwidth, you can compare bandwidth apples to apples, and even on some of these bearish runs, the bandwidth has gotten a lot higher than where it's at now. Even on the last intermediate pullback, it got all the way up here. So it suggests there might be a little bit more left to the move that we have going on here in the Qs. Let's go back to that intraday chart, and let's see, it's right here. So there's that gap, that potential runaway gap. Again, we gapped down a significant amount, finished down 2%. We ran right away from the open, so pretty good probability that doesn't get filled for a while. If it is indeed a runaway gap, remember that one had potential too, but we came right back into it the next day, so it nullified that and it did get filled in. We filled in that opening gap over here now yesterday, and then now again potential for a runaway gap will be harder to fill that in. That's SPY. IWM not so much. But you can see how important IWM is here. Like if it holds 220, great. If it breaks 220, then you'll see small caps kind of joining what we're seeing from the Qs, right? The Qs, did form a new 4-week low, so the Qs did get a new Arun indicator here, a new Arun indicator up here. So once it starts moving down, then we've set the low point. Especially once the green line hits the 0 and the red line starts moving down, then there's a good probability that we've set the low point on the intermediate decline. So we haven't done that yet, and we haven't even gotten to 100 yet, like we did briefly there on SPY, and you can see we already have moved down. The idea though is we may be re-threatening that new low point again with a move back up to 100, especially if it does that before the green line hits 0, which would be in the next day or two for these indicators. So that's what the intraday chart's looking like. You saw the volume, so when you compare that volume on SPY and the range was below the average 3 points or so, but not extreme. The volume is at 82 million, so both those lines are still rising, considering there's a small gap average with yesterday's big gap that averages out to not an extreme number. So it kind of, again, you get extremes, you bounce right back up. And the fact that we didn't bounce back up immediately, I tweeted out the other day. I quote tweeted this from Charlie Bilello about, he mentioned that we haven't had a 3% drop yet this year. We had 16 last year. Well, those 16 drops occurred here in that time frame during the COVID drop. Most of those, 75%, occurred in one little drop, one big drop. But so did most of the up days. Most of the up days for SPX in 2020 also came during that same move. So when you get these big drops to the downside, they're typically accompanied by bigger moves to the upside. But you notice we didn't get that today. Very shallow move, which again suggests that it might be some more downside. You see, like usually you get these big down moves, 2% or more, we bounce right back up, right? Here we actually followed through with the downs. We gapped up the next day, but then fell, but then followed up with a big 2% move to the upside. 2% move to the downside, followed by big moves to the upside. Even a 1+% move to the downside was followed 1.5. Yeah, over 1 2/3 was followed immediately by a more than almost 1.5 move to the upside. So we get a 2% drop yesterday, and it's followed up with less than 1/4% rally today. So not quite, the bounce back, which again suggests, the bulls are having a hard time buying this dip, like we've seen in the past. If you look at the volatility index, it stayed high. So it dropped 3%, but it stayed above 95%. So that's an important consideration too, as well as when you again break above the 200-day moving average, you usually come right back down. And so we broke above the 200-day moving average, and we're not coming right back down yet. So it remains to be seen. You notice the 8 and the 17-day have both crossed. The 200-day moving average is sitting right there on the 20 level. But now the 8 and the 17-day moving averages have crossed below. This is the first time that they both have crossed. The 17 came close there, but we dropped back down quick enough that it didn't. Now we're moved up so fast, and now they're both up there. You can see some other instances. Here the 8-day crossed up above. Over here, during the last intermediate decline that we had, the 8 and the 17-day moved above the 200-day moving average. If you come back to COVID, you can see over here when the 200, there's your 200-day moving average right there. And you can see when the 8 and the 17-day move crossed over there in late February, it stayed at that point. So it actually had a little bit of a false start initially there. The 17 got above the 200 over there too on that divergent. We had that divergent high point there. So some of these other intermediate pullbacks, you can see the 8 and 17-day cross to 200. We stayed up above it long enough to get those lines up. That was an intermediate decline. So in this chart, that's a sign that we are in intermediate decline mode. And but we're not quite, especially not done yet, because you don't get an intermediate decline unless you get the VIX above 100% relative to VXV. More likely 105, but it's got to at least be above 100. We haven't done that yet. So 105% is typically where it gets to that typically starts the intermediate run. So we haven't really even, remember, a lot of the intermediate lines are not in bearish territory yet. Not on the S&P, not on the Dow, not on the Russell. Russell's still in bullish territory. So it's kind of hard to finish an intermediate decline when your intermediate lines are still in bullish territory, much less, in neutral for the S&P and the Dow and the NASDAQ with such extreme of bearish short-term sentiment that we have. So it seems like we're just kind of getting started on an intermediate decline here for the S&P 500. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What do you think? Why are you either a lot more bullish than I am or a lot more bearish? Maybe you think it's going to be more than, maybe you are a doom and gloomer. Like you do think this is it. Like it's going to really drop more than just 5 to 10%. Let me know why. What are you looking at that suggests that down in the comment section down below. Before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us you liked the video today and that you want us to do another video again tomorrow. Quick way to give us feedback if you like our videos. Of course, if you don't like our videos, you don't have to click on anything. You don't even have to watch. But if you do and you want to let us know, you can click right now while you're watching. Also, comment down there what stood out to you from the videos today. People come by checking out the comments all the time, seeing what people say about the videos. So post down there what you got out of it and what stood out to you. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here, come down over here on the right-hand side, check out some of these things that we have, including our Market Outlook live video. Click on that icon. It takes you to this page. This is where I review all the existing trades that we've done in previous Market Outlook videos. See, it's one thing to actually do a trade. It's another thing to actually position size it, manage it, all the way up to the time that we close it. That's all very beneficial to you, right? Kind of trading as part of a portfolio. So we do that on all these trades ideas. These are a small portion of all of our class trades. We review all those Market Outlook trades in this class. Here's all the archives. Again, you can get to that by clicking that icon. Click on this view more or this trading room to see all of our classes that we have scheduled, as well as all the recordings over here. You can check those out as well, our upcoming classes here this week and going into next month. Click on this, come down here, click on that heart icon. It opens up a new tab. Hit that like button. Also click this thumbs up icon here. It opens up another new tab. Hit that like button as well. Again, the more you do that, it helps us it helps get our content out to all of our followers because of the engagements. The more engagement it has, the more our followers will see it because of how their algorithms work. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, now let's take a look at what's driving the price action today. And you can see the biggest mover today was the US dollar, interestingly enough. That was a pretty tremendous move to the upside for the greenback. And you can see real estate hard, again, this kind of inflationary story, weak, or in this case, rising yields. But you can see bond yields rose throughout the day from the open, but then bonds ended up higher. So kind of a risk off trade from that perspective. The gold underperformed and pretty much also underperformed equities as well, as they were all kind of pulling back. If you take a look at this chart here, the 12 grid chart, this one, you can see that big drop. That was a tremendous drop in the dollar or in the euro. A lot of the other currencies did dropped as well considerably. You can see bonds are getting an oversold cluster along with the dollar. So these, again, kind of two safe haven trades. Interestingly enough, that we have this intermediate decline on equities because you can see equities are dropping, but so are the safety trade. So is this particular safety trade, and so is gold. So you got two safety trades aside from the dollar that's forming an overbought cluster in that case that are forming oversold clusters. So again, it's like, man, can we have an intermediate decline where your long-term bonds and gold are both oversold? Right. So it's kind of interesting to see that, and you can see the yields really jumping up and breaking out. Crude oil also still not really pulling back either. So again, that's not typical. That's very atypical of an intermediate decline. You can see copper is not really dropping very much. Silver really dropped yesterday. And you can see emerging market stocks, developed market international stocks both dropping along with the S&P 500. I mean, all these major economies are out there, and their stocks, their large cap stocks, all dark pink shading and red lines all across the board. The only two that aren't are India and Russia, and Japan. Japan's pulling back to its moving average, but still, above it. Everything else is below dark pink shading and red lines. So pretty broad base selling in equities. It's just interesting that other asset classes aren't necessarily joining the party, so to speak. I mentioned the strong move in the dollar. Well, actually, let's take a look at the commodity 12 grid here really quickly. Here we go. Yeah, you can see heating oils ramped up. Natural gas had been a big mover. It's been pulling back here over the last couple of days. Crude oil is high. So you're getting this kind of run up in these commodity prices. Not so much the agricultural. They're down, light green shading and red lines. But look at gold and look silver, platinum, copper, kind of some more industrial type use metals, and they're not doing so well. So bearish across the board over here in the middle, bullish up here, which is kind of interesting, and that might be putting pressure on prices when you got higher input costs in terms of some of these crude oil kind of type commodities there. Now let's take a look at the currencies, and this is what I wanted to show you, this comparison here. And again, let's just look at today alone. So September 29th. And we'll come back to like a 10-minute chart. So your dollar rallied against everybody. And this time, the euro did not rally against the franc and the yen, or even against the Canadian dollar for that matter. It dropped pretty sharply. And it was down, way down here. And the pound's down here. The New Zealand dollar's way down. The Australian dollar's way down. The dollar really broke out. Big time breakout across. If you take a look at the 12 grid, here's the pound and the euro and the pound. You can see the Australian dollar breaking down. You can see the New Zealand dollar breaking down. The euro's breaking up against the pound. The pound and the yen. You can see the pound's dropping against the yen there. The Australian dollar, and not really. These two are kind of sideways, not really breaking out in one way or the other. You would expect in a risk-off mode that the Australian dollar would break down against the yen, along with the pound and the euro, and you would also see the euro break up against the Australian dollar typically. And you can see the U.S. CAD kind of going sideways, but look at the U.S. breaking out against the yen there. Big time jump. So really beneficial for Japanese stocks when the yen drops like that, drops as much as it is dropping here against the U.S. dollar. So that would actually be a benefit for any international investors in Japanese equities especially. Now let's take a look at how the sectors performed today. So we'll come here to the comparison chart and just look at today again, today alone. You can see your biggest winner, utilities. Finally, utilities, Brandon tweeted out about this. Utilities have had this insane move to the upside, especially against energy stocks, or to the downside, excuse me. Energy stocks have really broken out to the upside against utilities. Big time move, one of the bigger moves we've seen in a while. Last time was over here when we were so far down, and we finally got above the 200-day moving average. And that kind of led to a strong move in energy stocks. This was kind of a bullish intermediate run. You had this strong move in energy stocks for a while. You had a couple little drops there, but for the most part, we really kind of broke out after getting a strong push to the upside and a strong push on the MACD and a strong push up into strong levels in the CCI. And it appears that that's the case again. Big move on the DMI, suggesting that we might be in that kind of move again. And now, granted, the ADX was already pretty strong. We went from a strong bearish move to a strong bullish move. We did have a relatively strong bearish move here, but we had already moderated that move before we got this breakout. So, we could very well get a little bit of a consolidation here of this before we really get moving to the upside again. So I expect it will probably come back down towards that 200-day moving average. We already did today. And again, that would mean utilities are outperforming energy stocks. Would mean more days like this, right? This was a risk-off day, as you could tell. The S&P was up a little bit, but really your tech stocks were down, communication services stocks were down, all your cyclical stocks were down. And the only things that rallied were your safe haven. All of these safe haven areas and materials down the most there. If I look at the 12 grid for the sectors and compare, how they're looking like, again, you can see your tech stocks up here at the top, and look how bearish they are outside of discretionary. There's your cyclicals, again, materials and industrials not looking good at all. And that was one of the signs that we saw that we're not as bullish as we thought we were going into that rally. And of course, again, how can an intermediate run be ending when your safe haven areas are extremely oversold? So, if money starts moving in, they're all producing oversold clusters. If money starts moving into the safe haven areas, that would be, as well as into long-term bonds and into gold, then that would be a sign that, money is moving towards, that risk aversion is abating, and risk appetite is abating and risk aversion is increasing. All right, so for our trade idea, one of the worst performing areas in the market right now is semiconductors, or semiconductor stocks. You can see very, very bearish drop in the last 2 days. I bring the momentum line and the near-term line down. The intermediate line, we're 5% below the moving average, the 30-day moving average here. You can see the intermediate line, last time we were 5% below, the intermediate line got down the bearish territory. Same thing over here where you're in bearish territory, and over here you were close to being bearish territory. We're still in bullish territory, so I think there's an opportunity here for a little bit more of an extended run to the downside, considering the intermediate line just barely started moving to the downside. If you take a look at the long-term chart here for applied materials, you can also see too, we don't really have a bearish trend, a Hakunashi trend going. So we haven't really had we've had this strong convergence, but that convergence, as crazy as it is, it's still at 10%. Applied materials are still a stronger long-term momentum than the S&P. The S&P didn't even peak at 10%. It peaked at these really strong levels at about 9%. So applied materials have been so strongly bullish, up 30% between the 50 and 200-day moving averages, which is insane. We're still, after all that convergence, we're still at 10%, which means we're still, even back over here, that's about as high as we got, 15 double digits there before pulling back. So, we're still really, really bullish, and we haven't started a bearish intermediate run yet. We haven't had, a bear. We might be starting one. We haven't had one yet. If you take a look at its 3 green arrow chart here, you can see that we do have 3 red arrows. We did not bounce right back up to being clear. We won't, even if we were to bounce up tomorrow, we won't be clear here. So we are definitely in pullback mode with strong volume, 2 days in a row of above average volume down there. When you look at the 2-line version of this chart for applied materials, you can see yesterday we broke below the 8, the 17, the 50, and the 30 all at the same time, and then followed through with that with another big bearish move to the downside today. MACD is just turning negative, which means the 8 days is turning the 8 days just turning below 17. Neither one of them have crossed below the 50 or the 30 yet. That's still coming. And then you can see where the 200-day moving average is, and you can see there's not very much support below that 200-day moving average. Look at that big convergence. If this thing were to drop, you can see it better here on this chart. if we were to drop, you can see there's just not very much of a move. In fact, you kind of get an idea of, you know, this move off of the Halloween low point, which is just insane. This move off the Halloween low point for Applied Materials. You know, again, that's the same move that the S&P has had, right? And then, you know, we peaked over here in April, early April. We've been sideways ever since. So again, you break through that 200-day moving average. Let's go back over here to this chart. You saw there's no volume down below there. But if you break that 200-day moving average, you're also going to be breaking that 23% level. So a move down to 111, if not eventually down to below 100, is definitely within the realm of possibility, considering that there's no volume down. A little bit there, but not very much, considering what we're breaking down below right now. That was the other thing we broke down yesterday, the 8, 17, 50, 30, and the point of control. And then broke even more below that volume node today. So needless to say, Applied Materials is on a bearish breakout. Like you can see, like, is it too much? No, we're not even above 30 yet here on the negative index. We're just barely dropping below 20, so it's hardly extreme. The ADX is still very low. It's hardly extreme. The stock has not even broken below its cloud yet, or just barely broke below its cloud today, and hasn't even started a bearish trend here. It just barely ended the bullish one that it was on. And you look at its RSI and the CCI, you can also see bearish breakout patterns here, below 40, below minus 200. So we are definitely in breakdown mode. Of course, the question is, you know, how much, how long, and, you know, again, the idea being that if we were even to come down to 111, you know, that would be a significant move, if not more, because there's just nothing there to hold it up at those levels besides from that one Fibonacci retracement line. So for this particular stock, we talked about previously looking for some more positive Vega trades. So what we decided to do here was to buy a put, the 115 put, and sell the 110 put for November expiration. You can kind of see where we position size for this. It's already actually more expensive than where we got into it. So we're up just a smidgen from where we got into it before the market closed. We have about a 5-to-1 reward to risk ratio if this works out. And if it doesn't work out, then we can keep our loss minimal, half of what we normally risk on a trade. And so we've already cut our loss in half by position sizing, and we can cut it even smaller if it bounces right back up and doesn't work out. We can keep it down to a few $100 or less. For a $2,500 reward is a pretty decent reward to risk ratio here. All right, so that wraps us up for today. You've heard from me now. I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have about today's video. Reply to anybody else's thread, and let's keep this conversation going. As always, thank you very much for watching. Remember to subscribe to our YouTube channel as well as our website at marketscholars.com. Like it, click that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.